For years, the standard advice in personal finance has been to save 3 to 6 months of expenses in an emergency fund. But lately, more and more financial educators have started pushing that number toward the higher end of that range, and in some cases recommending a full 6 months as the real target rather than the minimum. Today we are going to talk about why 6 months has become the widely discussed benchmark, how to actually calculate what 6 months means for your specific life, where to keep that money, and how to build it up if the number feels completely out of reach right now. This video is for educational purposes only and is not personal financial advice, so please consider your own situation carefully or speak with a financial professional before making major decisions. Let us start with the basic question, why 6 months at all? An emergency fund exists to cover the gap between something going wrong and your income recovering. That could be a job loss, a medical emergency, a major car repair, an unexpected home repair, or any other sudden expense that would otherwise force you onto a credit card or into debt. 3 months of expenses was historically considered a reasonable buffer because it assumed a relatively short job search and stable industries. But the modern job market looks different than it did a few decades ago. Layoffs can happen with little warning, job searches in many industries now regularly stretch beyond 3 months, and economic downturns tend to arrive suddenly rather than gradually. Because of this shift, 6 months has become the widely discussed standard, particularly for anyone whose income is variable, anyone who is the sole income earner in their household, anyone working in an industry prone to layoffs, or anyone who is self-employed and does not have the safety net of employer benefits. Now let us talk about how to actually calculate your own 6-month number, because this is where a lot of people get stuck before they even start saving. The first step is figuring out your true essential monthly expenses, not your total spending, but the amount you would need to survive if you lost your income tomorrow. This typically includes housing costs like rent or mortgage payments, utilities, groceries, transportation costs, minimum debt payments, insurance premiums, and any other truly essential recurring cost. It does not need to include discretionary spending like dining out, subscriptions you could pause, or entertainment, because an emergency fund is meant to cover survival, not your normal lifestyle. Once you have that essential monthly number, you simply multiply it by 6. For example, if your essential expenses come out to $2,000 per month, your 6-month target would be $12,000. That number might look intimidating at first, and that is completely normal. Almost everyone feels that way when they first calculate it. Here is something important to understand. 6 months does not have to be your starting target. If $12,000 feels impossible right now, start with a smaller milestone, something like $1,000, which is widely discussed as a starter emergency fund, designed simply to prevent small emergencies from turning into credit card debt while you work toward the larger goal. From there, you can build toward 1 month of expenses, then 3 months, then finally 6 months. Treating this as a staircase rather than a single giant leap makes the process feel achievable instead of overwhelming, and it gives you real milestones to celebrate along the way. Let us talk about where this money should actually live, because this matters just as much as how much you save. An emergency fund should never be invested in the stock market, because the entire point of this money is that it needs to be available immediately and without risk of loss when an emergency strikes, and markets can drop in value right at the exact moment you might need to access the cash. Instead, the widely recommended home for an emergency fund is a high-yield savings account, sometimes called an HISA, which is a savings account that typically offers a significantly higher interest rate than a traditional brick-and-mortar bank savings account, while still being fully liquid, meaning you can withdraw the money whenever you need it without penalty. Many high-yield savings accounts are also insured by the Federal Deposit Insurance Corporation up to the standard coverage limits, which adds an important layer of safety. Keeping your emergency fund completely separate from your regular checking account is also a smart habit, because it removes the temptation to dip into it for non-emergencies, while still keeping it easily transferable when a real emergency does happen. Now let us talk about how to actually build this fund if you are starting from zero or close to it. The first step is automating a fixed transfer from your checking account into your emergency fund savings account every single time you get paid, even if that amount feels small at first. Automation removes the willpower requirement, because the money moves before you have a chance to spend it elsewhere. Second, consider directing windfalls toward this goal, things like tax refunds, work bonuses, or cash gifts, since these are often unplanned money that has not already been assigned to a bill or a lifestyle expense. Third, look for temporary ways to increase your income, specifically earmarked for this goal, such as selling unused items around your home, picking up freelance work, or taking on overtime hours for a defined period of time. Fourth, revisit your budget for temporary cuts, not permanent lifestyle changes, but short-term reductions specifically aimed at accelerating your emergency fund timeline, such as pausing subscriptions or cooking at home more often for a few months. It is also worth addressing a common question: should you pay off debt first or build your emergency fund first? The widely discussed approach among financial educators is a hybrid one. Build a small starter emergency fund first, something like $1,000, to prevent small emergencies from creating new debt. Then aggressively pay down high-interest debt like credit cards. And once that high-interest debt is eliminated, shift your full focus back to building your emergency fund up to the full 3 to 6 month target. This sequencing exists because high-interest debt typically costs you more in interest than your emergency fund would earn sitting in a high-yield savings account. But a completely empty emergency fund also leaves you vulnerable to new debt the moment something unexpected happens. One more thing worth mentioning: your credit profile can actually play a supporting role during a financial emergency, even when your emergency fund is not enough to cover everything. Having a strong credit history can mean access to a low-interest personal loan or a favorable balance transfer offer if you ever do need a bridge beyond your savings, whereas a weaker credit profile can leave you facing much higher interest rates exactly when you can least afford them. Because of this, checking and monitoring your credit profile regularly is a smart complementary habit alongside building your emergency fund, not a replacement for it. There is a link in the description and blog post below to a service offering a very low-cost trial for exactly this kind of ongoing credit monitoring. It is also worth talking about how your 6-month target should change as your life changes, because this is not a number you calculate once and forget about forever. If you take on a new mortgage, have a child, change industries, or become the sole income earner in your household, after previously splitting expenses with a partner, your essential monthly expenses will shift, and your emergency fund target should shift along with them. Many financial educators recommend revisiting this calculation once a year, or any time a major life event changes your monthly obligations, simply to make sure the safety net you built for an earlier version of your life still matches the version of your life you are actually living today. Another consideration worth mentioning is what counts as a true emergency versus a planned expense that simply was not budgeted for. A car breaking down unexpectedly is an emergency. A holiday season arriving in December, which happens every single year on a completely predictable schedule, is not an emergency, even though it often gets treated like one. Being honest with yourself about this distinction protects your emergency fund from being slowly drained by expenses that could have been planned for in a separate sinking fund instead, which helps the 6-month cushion actually be there when a real emergency shows up. To bring this together, 6 months of expenses has become the widely discussed target for a modern emergency fund because job markets and economic conditions have shifted in ways that make a shorter buffer riskier than it used to be. Calculate your true essential monthly expenses. Multiply by 6 to find your target. Break that target into smaller milestones if it feels overwhelming. Keep the money in a high-yield savings account completely separate from your everyday spending, and automate your contributions, so the habit builds itself over time. An emergency fund will not prevent hard things from happening in life, but it will give you room to breathe and options when they do. If this video helped you think through your own emergency fund target, please subscribe to Yield Report Daily for more breakdowns like this one every Monday and Friday. Thank you for watching, and we will see you in the next video.